definitely learned the limits here this week about how AI fits into bull cases for tech outside of chip makers. Let's talk about the situation with Graham Weaver joining us, founder and CEO at Alpine Investors, private equity firm, and a good perspective here for us. Graham, so is it any better in the private markets, the way valuations have held up in some of these tech companies? Because they really got slammed this week in basically everything software.
I'd say software has gotten slammed in private equity as well, but not necessarily this week, but over the last year. Yeah, we've definitely felt that, particularly in subscription software companies.
Well, why do you think it's happening? I mean, some of it seemed like when rates were going up, it was just kind of a natural response to go through the market, take a fine-tooth comb, figure out who's got the best model and who makes sense, who makes money. But now that we've kind of injected into this AI steroid, is this like a come down from that or what?
I think it's Warren Buffett says the three most important words in investing are margin of safety. And I think that perfection was priced into these software companies and a lot of money poured into software, and it just doesn't happen. Perfection never happens. And so when the companies start to fall a little bit short of that, the valuations just are or the markets are unforgiving, and they take a pretty big beating.
Does it limit the possible outcomes for private companies? How many of these are eyeing public markets or looking at an IPO pipeline that maybe got scared off?
Yeah, I think what happens in times like this is just transaction volume just dries up. So if you think about private markets, you have to hold companies on your books at a certain value, and then if you can't get that value, either selling the company privately or taking it public, you're not going to transact. And so if you look at just about any league table, the effect has been deals have just basically come to a screeching halt, and they're down. The volume of transactions is down significantly over the last several years.
When you look at the impact, then what does that do? Does it force transactions? Does it force consolidation? What do you see as kind of the driving themes then if we look at that category of what used to be high growth tech businesses that maybe aren't quite growing, but some trying to latch on to some of these new AI tech?
I think in the short term, people just stay on the sidelines. So they kind of hunker down and just really kind of tighten their belts and maybe pull back on costs, and that's what happens in the short term. In the medium and longer term, valuations will correct. So either this will be the sustained valuations, and people will accept that this is the value, and they'll start to transact at lower prices, or maybe the government starts cutting rates a lot faster. Maybe the AI starts to provide a tailwind, and they come back. I can't predict what's going to happen in the macro markets. I will say I'm not really holding my breath for the AI, which we can talk more about if you want.
Yeah, no, please do elaborate. Go ahead.
Yeah, so I lived through the 1999 with the .com era, and I was graduating from business school back then. And literally, I actually wrote a business plan that I did for a class. I wrote it in about 90 minutes, and we had to present it one time to investors as part of the class, and every single one of those investors who were real people wanted to actually fund the plan, which was actually shocking. And that's kind of where we are in AI. AI, just like the internet, AI will 100% transform our lives as we know it, and just like the internet, in ways we can never even envision right now. But also, just like back then, most of the companies and most of the impact that is happening right now is most of the companies that are started right now are not going to work out well, just like the .coms, and the impact's going to take a lot longer than people think. So the technology is real. It's going to have a massive impact, but people, just like the internet, it's overhyped in the short term, and a lot of the things that people are investing in right now are going to probably not materialize the way they think.
What role do credit markets play right now in kind of determining this fate? Do they generally still look healthy, robust, or how do we kind of compare to where folks thought it was going to be when we started jacking up interest rates? Because, I mean, generally things have calmed down on the rates front a bit.
The credit markets are wild. I've been in private equity 30 years, and I've never seen this dynamic before. So what's happening in the credit markets, if you go back like a year, you could invest in A-rated debt that had a 25% loan to value. In other words, it's money good, and you could get 10 to 12% returns on that money, on that credit. That's insane, right? That's way better than you can do in the public markets over a long period of time. And you can do that with taking a fraction of the risk. So as you would imagine, money poured into the credit markets. So that's what happened like a year ago going back. But now, go fast forward, there's no transaction volume. And so all that money sitting on the sidelines just pent up. And so you can actually get deals done we will send a term sheet out. We'll get lenders, like more lenders than we've ever had bidding on that, and they won't even mark up the term sheet. So the money is flooding in, but it's still at high rates. So it's kind of a weird dynamic where the money's expensive, but it's also really, really plentiful. So I think it is, as always happens, when something looks kind of really attractive, money just floods in really quickly, and that's where we are in the credit market. So it's a weird time. I haven't seen this in 30 years.
Yeah, it's a really great way to describe it, and a good perspective of how you see it in the private markets, just from sort of the perspective of watching rates from a sort of macroeconomic standpoint. The curve, yield curve's basically been stuck in the same place. It's like we're treading water, and some call it Goldilocks, and maybe that's the kind of way to think about it, but it certainly creates sort of an awkward situation where there's, it seems, a need for growth. There's a need and a willingness to spend for growth, but it's going to come at somewhat of a higher cost. So does that generally allow things to function smoothly, though? Do you feel like you have good offerings when you talk with clients that want private equity allocations in their strategy right now?
Yeah, it's a really weird dynamic, because usually when you say the credit markets dry up, they get expensive, and they're also just, there's no money available. This is not that. There's plenty of money available. There's more than we've ever seen, maybe, but it's just really expensive. So the effect is you can get things financed, but it's a lot more expensive. And so, if you have something that has a lot of leverage, whether it's commercial real estate or private equity companies that you use to borrow money, you're paying a lot more on interest. So you have less money to invest in growth, and that is taking a toll, and that is what causes the slowdown, which is kind of what the Fed wanted, and we are seeing that. We are seeing a little bit of a tightness with the consumer now.
So the last point, that where the rubber meets the road, do you think investors can generally expect the same type of returns from a private equity investment that they would have been able to 4 or 5 years ago?
Okay, you have to take this with a grain of salt, because I'm in this business, and so take this answer with a grain of salt. But these historically are the absolute best times to invest. So people are on the sidelines. As Buffett says, be fearful when others are greedy. Be greedy when others are fearful. Right now, people are fearful, and this is a time for, at least in the private markets, to be greedy. And so we think this is maybe one of the best times to invest that I've seen in the last 5 or 10 years. So we're trying to be super aggressive, notwithstanding all the kind of noise and chaos that's going on in the macro environment.
All right. So it sounds like maybe a little choosier process, but still returns possible. Maybe just a little higher bar to entry with rates. So interesting conversation. I like the perspective, Graham. Thank you for your time.
Thanks so much for having me, Oliver. Really enjoyed it.
Absolutely. Yeah, a good perspective for us, and one a little outside of the public equity realm, as we're so stock focused here. Graham Weaver, founder and CEO at Alpine Investors.